Okay, so moving on to Chapter 13, Statement of Cash Flows. This will be your second exposure to the Statement of Cash Flows. You actually were exposed to it in financial accounting towards the end of the class as well. So, all right, the reason why we have the Statement of Cash Flows is that it shows the overall increase or decrease in cash during a specific period. It shows how the company generated and used cash during the period. It helps stakeholders evaluate cash generation, usage, and ability to meet future obligations, and it helps managers understand if sufficient cash is being generated and will be available. So here's the basic format of the statement of cash flows. You're going to have the company name, the title, the year, just like any other report. But we're going to make sure that we break down our statement of cash flows into three categories. The first being operating activities, the second being investing activities, and the third being financing activities. Now, within these areas, you're going to get a little bit further breakdown. But this is just the regular format of what you would be expecting. Now, once you have the cash flows from each activities, you're going to sum those up, and then you're going to take into consideration the beginning of the year cash flow. And then once you've seen the change in the year plus what you started off with, you should have the end of the year cash. And this balance at the end of the year should be equal to what you're showing on a balance sheet. Before we get too much further on discussing how the statement of cash flows works, we really do need to discuss what is cash and cash equivalents. Cash would be pretty obvious if you have like a petty cash drawer in your office or the facilities wherever you work. That would be considered to be cash. If you have checking accounts or savings accounts, those would also be considered to be cash. Now, but we're going to expand it even beyond just the cash and drawers, checking accounts, and savings. We're going to include also very safe, highly liquid assets, money market funds, certificate of deposits maturing in less than 3 months, and U.S. Treasury bills. All these are going to be, if a company owns any of these, if they've invested in any of these, they would be considered part of cash and cash equivalents. So we've already talked about, based on looking at the format, we have three sections. The operating activities, that gives you a feel for what the day-to-day profit-making activities are. When you think of operating activities, this would be kind of like the income statement and how that's presented. Although the income statement, we should know by now, is not necessarily cash because we have accrual basis of accounting. But those items that are reported on the income statement are included in the operating activities section of the cash statement of cash flows. The investing activities involves buying or selling long-term assets. In most cases, we're going to be talking about property, plant, and equipment, stocks, and loans. And then finally, the final section is going to be financing activities. And if you can think about it, it could be anything that's really long-term liabilities and or stockholders' equity. Okay, so the first thing we're going to take a look at is operating activities. And as we discussed, these are cash flows related to the primary day-to-day profit-making activities of the company. These activities affect net income, current assets, and current liabilities. So a little bit more specifically, we're talking about money that's been received from sales or services. The cash, though, not necessarily the booking of the sale. It's actually the cash received from sales. Cash received from interest, dividends. We're also going to take in consideration cash paid to purchase inventory, cash paid for selling, general, and administrative expenses, cash paid in interest expenses, cash paid for income taxes. The focus here is cash. It's money that's going in and out of the accounts that normally you would expect to see on an income statement, but these accounts are not recording on an accrual basis. They're recording the cash that's gone in and out related to these specific accounts. There are non-cash adjustments that you need to make using the indirect method, and that is depreciation and amortization. If you recall from financial accounting, when you record depreciation that has nothing to do with cash, you're going to record the expense, and then you're going to offset accumulated depreciation. Same with the amortization expense. You're going to recognize the expense and you're going to credit whatever other asset is, whatever other assets associated, whether it's going to be goodwill or loan fees, copyrights, intangibles, if you recall. And then we have gain or losses on the sale of property, plant, and equipment. And again, the gain or loss on the sale of a property equipment is computed by taking the consideration, how much you sold something for, and you're going to subtract the book value from that sale, the book value. So once you find that difference, you're going to make a determination whether you have a gain or a loss on that sale, right? Well, that's going to be reported on the income statement, but that's not necessarily cash. In fact, it isn't cash. It's just the difference between the book value and what you received as a sale of the item. Investing activities, what I mentioned earlier, is going to be associated with long-term fixed assets, mostly long-term fixed assets. So the bulk of it is going to be from cash received from the sale of property, plant, or equipment, or cash paid to purchase property, plant, equipment. Those are the two areas where you're actually going to see most of changes when it relates specifically to investing activities. But you also could receive cash from the collection of long-term loans. So if a company issues a loan to another company or to another individual, when they begin collecting that money, that's going to be investing activities. Cash received from the sale of long-term equity stocks and investments. So if a company is heavily investing in other companies in the market, then the money that they receive would be part of investing activities. And then there's cash paid for purchasing long-term equity stocks or investments. Cash paid. Okay, so cash received, cash paid. It's really both sides, money coming in and coming out as it relates specifically to these types of investing activities. And then financing activities are really cash flows both in and out associated with long-term debt and stockholders' equity accounts. So as an example, more specifically, cash received from issuing long-term debt, such as notes and bonds, cash received from the issuance of stock, cash received from using a line of credit. Those are all incomes. Those are money coming in. That's cash coming in. And then cash used to pay back long-term debt. That's money that's been used. Cash used to pay dividends, and cash used to buy company stock, such as treasury stock. So those are all inflows and outflows associated with financing activities. Some of the things that are sometimes difficult to remember, interest income and dividend income, both classified as cash flows from operating activities because they affect the increase or decrease of net income. Okay, so interest income and dividend income are really operating activities. Interest expense, that's an operating activity as well. Why? Well, just think of it because it's on the income statement and they affect the income. So since the operating activities are really associated with those accounts that directly impact income, then that's why they would be considered part of operating activities. Certain revenues and expenses, such as depreciation, they're classified under operating activities as they affect net income, yet they do not generate or use cash. So we have to make adjustments associated with depreciation, amortization. We talked about that. The payment of dividends, though, is classified as financing activities because they do not, they're not expenses. So anything associated with an expense and revenue are that's really operating activities. And any payment that's not associated with revenues or expenses has to be elsewhere. Specifically, dividends would be classified as financing activities because that's associated with stock and equity, the equity section of the balance sheet. Non-cash investing and financing activities. If you can think about when you go buy a car as an example, when most people buy cars, most people don't just push out a ton of cash and say, okay, this is what here's $40,000 in cash. I want to buy this car. Most people don't do that. Some people I'm sure do, but most don't. When you do that, you may write a check for the down payment of the car. So let's say $5,000, $10,000, whatever it may be. You may write a check for that. So that is cash flow. But when we're talking about non-cash investing and financing activities, well, a company, when it buys the vehicle, it'll buy it similar to the way we do it. We go to the lot, find the vehicle, we buy the vehicle. So just like individuals, they may put a down payment. When they do put a down payment, that cash is outflow. But now they finance the difference. Well, technically the finance arrangement, the cash never goes into the accounts of the company. So we can't count that financing arrangement as either cash inflow or outflow. Yet we do have the asset. We do acquire the asset, but we didn't just acquire it for the down payment. We now have an obligation to pay it back over in the future. So the acquisition of that asset, it's then included in the balance sheet, but we would not include the financing arrangement as either inflows or outflows, because the money never goes into the account. Now, there is a chance that you can go to your credit union and they put cash into your account, and then you write the check out to the dealer. And when that occurs, then cash flow did occur. But under circumstances where the cash never entered your bank account, it's not really cash flow to be accounted for on the statement of cash flows. So we call that kind of a situation non-cash investing and financing activities. Investing because you now have an asset, car, automobile, machine, whatever it may be, and financing activity because now you have an obligation, debt. That's part of your balance sheet now. That situation when you borrow money to buy an asset and the money never goes into the accounts, those are considered non-cash investing and financing activities. Now, even though they won't be reported on the statement of cash flows or included in the calculations, you must disclose, they must be disclosed because they will affect future cash flows. And so the examples here: purchase of property, plant, and equipment by using common stock rather than paying cash. So there's another example there. And extinguish liabilities such as bonds or notes payable by converting them to stock. So when we're having a transition from equity to liability or vice versa, liability to equity, those there's not cash going into the bank account, so we don't really consider them to be cash flows, yet they still need to be disclosed. All right, there are two methods that are commonly used for presenting operating activities. There's the direct method and the indirect method. The direct method lists the receipt and payment of cash for specific operating activities. By the way, just so that we're clear, the difference between the direct and indirect method only relates to operating activities. The two other areas, cash flows from investing activities and cash flows from financing activities, are not impacted between the two methods. The two methods here, direct and indirect, only impact how the operating activities is presented on the statement of cash flows. So the direct method lists the receipt and payment of cash from specific operating activities, such as cash receipts from customers, cash payments for inventory, cash payments for salaries and wages, and cash payments for insurance. That's the direct method. The indirect method ignores the specific information, and it begins with net income, the bottom line net income that's on the income statement, and it reconciles it back to the cash through adjustments up and down based on changes that have occurred in certain areas of the balance sheet. We're also going to, non-cash revenues and non-cash expenses are going to be adjusted out, and changes in current assets and current liabilities. This is what I meant when I said changes or increases and decreases in items on the balance sheet. Sustainability initiatives also fall into the same three categories: operating activities, investing activities, and financing activities. Specifically, operating activities might include expenses related to researching and developing sustainable products and packaging. Investing activities would include cash flows associated with investing in solar paneling or wind turbines. And financing activities would be either stock issue to raise capital for biofuel production projects, or maybe even bonds or the issuance of debt, borrowing money. I mean, anything associated with financing activities. But this example here is relating to sustainability.